What's up, guys? Welcome to the Under Contract podcast. This is episode number 4. I have my longtime friend here. We've known each other. Well, I actually applied for a mortgage when it was like in 2013 or something. And I came, and that's when I met you originally. And you were like, hey, you haven't even filed a tax you don't even have a tax return. And I was like, what? I didn't even know. So that didn't work out. But then when I got my license and joined Remax First Source, You had an office there, and we've done a ton of business together ever since.
Yeah.
Mr. Clay Smith, he actually loaned me the money to buy this place. So I appreciate that.
It's nice. First time here.
Thank you. So why don't you just talk a little bit about how long you've been in the business? And
Yeah, so I got started in 2002, summer 2002. I went to school at Southwest Texas then. It actually changed when I was there to Texas State.
Eat 'em up, cats.
Yeah, there you go. I had a finance degree, and I was actually in college when I started. My brother graduated with a finance degree, got into the mortgage business, and then kind of taught it to me. So that summer we did my first loan and quit my waiter job at the grist mill and never looked back. Right,
the grist mill.
Been doing that ever since. So at that time, it was we're kind of talking about rates maybe today and where the market's going. So when I got into the market, it was in the middle of a refi boom.
Times were good then. 2002.
Yeah, well, I mean, so you had, and to give you some perspective, right? I mean, you had the .com boom, and like in the Clinton era, the economy was doing really well. Everyone was at 8 and 9% interest rates, right? So then, and that's typically how rates work, right? When the economy's, doing well and running hot, like, you usually get higher rates, right?
Right.
So then you had, the .com bust happen, and then 9/11. Happen. So that event, geopolitical event, has impact on rates.
Right.
But both of those, that uncertainty was what's going to come with war and all that. Right. So that then what happens, right? Stock market goes down, money flows into the bond market, rates go down. So people were coming off 8 and 9% rates, and we were refinancing them at 6.
Yeah.
So, and people were thrilled. Right. So that just gives you a little perspective of, where we're at now, where we were, and that, it's not that bad, right?
Yeah, because we're right around 6 now, and people are losing it.
Yeah, I mean, we're low 5s, but I mean, we were low 3s, but honestly, the run up in the rates is kind of the sticker shock and how fast. Mm-hmm. It's the fastest rates have risen in a quarter almost ever,
right?
In like 20 years,
Yeah.
But a lot of it's just they were held too low too long, so. Obviously, then they're rising quickly, and we obviously see all the inflation data, right? Which is what's the main pusher of rates going up.
It's alarming. What is it? 8 to 10%?
8.5%. But that's the highest it's been in 40 years,
right?
But back then when it was this high, rates were we hear the mom and dad first bought a house in the 80s, it was 13 and 15%, right?
Yeah.
So again, historically speaking, we're not in a bad spot.
Ronnie was telling me last week that half of Houston was foreclosed on in the late 80s.
Yeah, right.
So
it's crazy.
Everybody thinks everything's the end of the world when it happens, right. But like just everything going on now. But back then, I mean, that's way crazier than anything we're seeing now.
Correct.
So
yeah, I mean, and the economy's well, right? I mean, there's nothing. I mean, it's doing well. Everyone's employed. Everyone that bought a house is highly qualified. I mean, if you're in a house now, should really be no issue continuing to make those payments, right?
Right.
So it's a lot different than people. It's close enough, and people were around and own houses like in the 08, 09 crash, which this is totally different. I mean, and that crash was, it's just, and especially the run up in prices, right? Simple supply and demand, right? Economics. So then the run up in prices happened because there was over demand, but that was because there was so many borrowers and so many people buying houses that weren't qualified. That what created the high demand. Then when that fell out and that bottom fell out, that's what created the crash. Plus everyone that ended up with a house ended up with an arm or, couldn't really afford it. And then all those went to foreclosure. So,
and they throw the car in there. or whatever.
Right. So that's what created that true crash then, which now, I mean, it's the opposite, right? Everyone's highly qualified. People have, good credit, everything fully underwritten, full doc loans. And then now it's the lack of supply, right? So even if we have a little bit of a slowdown, which we will, it's getting to where the prices are going to, again, it's supply and demand and economics, right? Once the consumer finally gets to, fed up with the price and the payment and, the rates going up and the prices going up and that payment being so much higher, it's going to kill some of the demand. But, what are we in, like a 2-week supply of homes right now? In a normal market's like 6 months.
Yes.
So even a slight slowdown would probably even almost be a good thing for the market.
I've been saying that. But before we go any further, I just want to explain, your role in kind of, I'm the realtor, you're the loan officer,
right,
and then we have the title company. I like to say it's a triangle. So for everybody watching, unless you have cash, you're going to go talk to this guy here. Right. He's going to get you qualified for a loan and let you know what all different options are out there for you, whether it's FHA, conventional, VA, what have you. So we all work together. It's me, the realtor, him, the lender, and then the title company. We coordinate everything and just do what we got to do to get the file closed. So we have our own roles, and we like to stick to our own roles.
Right.
So
like Blake finds you the house. I provide you the money to buy the house. Title company provides the paperwork and everything to make sure the title and everything gets transferred from current owner to you. So that's like the three main pillars of like the process.
And to make sure there's no clouds on the title.
Right.
That's a big one.
Right.
So how's the 2022 market treated you so far?
It's been really good. I've got, like I said, lots of buyers, but it's hard for them to find a house.
Yeah.
That's been the main problem. So
same with me.
Right. I mean, I got everybody, having to put multiple offers in to get something, overpay, So I think that's going to start to wear on the consumer some, where they're just, hey, I'm out,
I've had that happen already, where people are just like, hey, we're going to wait.
Right.
Or I'm working with some clients right now that they were shopping like 500,000 to 600,000, but now they're just thinking like, hey, we might just buy something cheaper cash, because I guess they have that much cash, but so we'll buy it cash and just wait this out and then lease this out and then go buy something when the market calms down a little. I said, hey, I mean, I could totally see why you want to do that.
Yeah. And it depends on your price point too, but especially the first time home buyer market's even tougher. And I feel, it's so bad for those people trying to do it for the first time and they get frustrated and they can't, hey, my apartment's lease is up and I got to be out and they can't get anything. I mean, if you're that 200 to 300 first time home buyer, which almost sounds crazy, right? That because
300 first time home buyer,
right? 253. I mean, because that house was 150 when you were looking in 2013.
The house I bought ended up being 155,000. It was a 1,762 square foot 3.2. That same house today, I'm thinking would go for like 260.
Yeah, it's crazy.
Yeah,
and that's the starter home, right?
And I sold it for 215 2 years ago.
And now you're kicking
so
yourself
I'm like,
out.
Man, should have kept it.
I had my starter home in like 2005. Moved, rented it, and then sold it when I didn't think it could go any higher. 3 or 4 years ago, and now I'm same thing.
Didn't you pay like 120 for that?
Yeah, like 115. It was a foreclosure, but it was a good foreclosure, and I probably only got about maybe 10 grand in equity because it was still really, it wasn't all tore up, and I didn't want to have to do a ton of work, so it worked out well. But, when 08, 09 happened, I mean, it dropped to maybe 100,000.
Right.
And then I, but I rented it, kept it going, was able to buy my next one low, and then rented it out for that amount of time for another, 4, 5, 6 years, and then sold it for almost 200.
Right. So, yeah, I mean, but that was back in the day when, if somebody bought a $400,000 house, then all of a sudden you wake up one day and you turn the news on and you see everything crash into the ground. Your house you bought it for $4, it's now worth $3.
Yeah.
You owe $400. It's probably like over 100% financing. So people were just moving out of their house and giving them back to the bank.
Yeah, it just wasn't. They just didn't feel like it was worth it, or they just walked. Or lots of times people and consumers were getting honestly pushed by bad malicious loan officers so they can make more money into ARMs. Mm-hmm. So after their 3-year ARM was up and their rate shot up 5%, then they couldn't afford it.
Yeah, and
that was a majority. That's all part of it as well, right? And not to mention that they probably didn't even prove their income to get it lots of times, so they really never afforded it to beginning, or they were already stretched.
Wasn't it just like stated income? You just basically just say what you made, whether you made it or not.
Yeah, I mean. And they kind of tried to do a kind of a litmus, like smell good test. I mean, if you were a teacher, you couldn't say you made 200 grand, right?
Right.
I mean, you kind of needed to go along with the profession. But if you wanted a no doc loan, you could do no doc, and it would be it'd be name, social, date of birth, and address. And if you had a 680, you got 100% financing.
Yeah.
And there would be no questions. Honestly, we called it the drug dealer loan, right? Because it didn't matter what you did.
It's funny you say that. I have a buddy who was a partner in a mortgage company at that time, like 2005, 6, I think it was. And he said that he had a guy he knew. He was like, this guy was not a good guy. Like, he was a shady dude. And he got his mortgage lender's license. And in his first year, he did, I forget what the number was his first year, but his second year, he made 700 grand. And he said, right then and there, I knew that this is not.
Yeah, it's too much money.
Yeah.
Right? And there's too much money being made. You can tell that there's a problem, right?
Yes.
And that greed guarantee he's not in the business now, right? Because when that transition happened, all those guys that didn't even know how to do a real loan, read a tax return, read a check stub, they went away instantly.
I think that's kind of what's going to happen with the way it is now. I think it's going to flush out a lot of, maybe part-timers or.
Well, on both sides of the industry, right? I mean,
Yes.
It's so easy to list a house and put it on the MLS and it's gone, right? I mean, what value did you have to bring to do that,
Yeah, I was showing some houses in Pearland a couple days. It's been 2 days ago now. The listing we got to the house and my people asked what the square footage was. So I went to pull it on HAR. Square footage is not there, and I'm like, how are you going to put up a listing without the square footage? So then I'm like, okay, well, let me get back to my computer and figure out what's going on. So I come to find out this lady had misspelled the street name on the listing. Yeah. So that was the first problem. And then she put the house in the wrong county. And I'm just like, man, this lady's getting paid 3% of this sales price to do this horrible of a job.
Yeah.
And we actually sent him an offer, and it's been 2 days, and she hasn't answered the phone. She hasn't emailed us back, nothing.
Yeah. Yeah. So, I mean, the professionals will last.
Yes.
And then reap the benefits after, if you got the good, stable, networking groups and things that you've built over the long haul that will pay off. And times get tough, right? I mean, we're 100% commission.
Yep.
Right. So the good times are good. You better save for the rainy day, right? And you got to make it through the next time, right? Till you reap the benefits. But that's just part of the gig,
right?
Yeah.
I mean, I feel like a lot of people saw how the 2015, 16, 17, 18, 19, 20 market was. And it's like, it just kind of looked easy probably to be a lender or a realtor or whatever. But what do you think, as far as the 2022 market, how is it compared to, say, this time in 2018, 19? In your opinion, like your take on it?
Yeah, I mean, obviously that's like pre-pandemic, and we're maybe getting like post-pandemic a little, right? So, I mean, the market was, 18, 19 was kind of the same, right? I mean, it was a little bit slower market, just because rates had kind of gotten to where they're at now. So everyone that had bought in that 16, 17, 18, 19, and when the pandemic hit, those were where all the refis came from, right? Which the market's always cyclical, man. I mean, about every 7 years is really where it's supposed to turn. And really, after 0809 crash in 2010, I mean, we haven't been in a recession or really had one since then, right? So we're going on like 12 years without a recession, and like the market's going to have to turn over eventually, and that's just how it works. It can't go up forever. So, I mean, the slowdown I think that's pending is coming, and I don't think we've quite seen it yet. But I feel like it'll be here. But the business will still be good, and homes are still. I mean, as far as interest rates are still a good deal. And real estate is still always one of the most safe, the safest investments you can make. And if you bought in 0809, even when that crash happened, and your house did drop $100,000, well, it's up another $100,000 if you were able to stay, right?
Yep.
So and you got to pay to live somewhere. So you might as well be paying into something that's forcing you to gain equity and save money and build an asset for the long haul.
I heard this guy Ricky Caruth I follow on Instagram. He was the number one agent in Alabama for Remax for a while, but he always says, like, look, no matter what's going on in the world, the closings will happen by the truckloads every single day forever.
Right.
Period.
For sure.
Yeah, because whenever COVID hit, like March of 2020. I thought we were chalk for that year. I mean, I thought it was just going to shut down. Showings weren't going to happen.
Yeah, same.
But it was the complete opposite.
Yeah, I mean, I agree. I I just closed on a construction loan to build a brand new custom home. And I was
yeah.
like, hang on, like the whole world's about to end, right? And, waited 2 or 3 months, but had some of the best months of my career. So I said, okay, let's do it. The refis hit, and then really the purchase market never slowed down, really. No. And obviously lots of people, it was tough times for lots of people and they lost their jobs and stuff, but I think it was a short run, that it happened. And then depending on like what industries and stuff you were in, I mean, obviously anyone in the service type industries or travel or hotels, I mean, all that industry is what really got hit hard. Right. But many other industries still, held and didn't have an issue.
Could you imagine being a restaurant owner during that?
Yeah. I mean, I don't know.
Literally the government just blocking off the ability for you to make a living.
Yeah. It's crazy. Hopefully we never have to deal with that again, or hopefully we learned, kind of what happened there, and like that probably a lot of the shutdowns were unnecessary in the end.
Yeah.
And did it really change anything? It's hard to say,
well,
but
yeah.
But you see the areas that are like shut down still, or like, in the last year were completely shut down. And do they have any more cases than what we did? No. I mean, my kids have been back to school for 2 years and yet the school district still closed. There's no issue.
Yeah.
So hopefully, I think maybe we've learned a lesson there. And, I think as Americans see, like, part of what makes this country so great is our liberties and our freedom, and we don't need that government thumb on us.
Right.
We can make our own decisions health wise and everything else.
Especially in Texas.
Right.
Yeah.
Which is why we see such a flock right here. I mean, that's another part of why it's so crazy here, and you see, I don't know where honestly, where all this cash is coming from. I mean, every time I'm like, my guys are trying to buy $500,000 houses, and they're like, we lost out the cash. And I'm like,
yeah, I
don't know where all this cash is coming from. I mean, I guess it's a lot of it's, California money, or these people are relocating,
Yeah. Yeah, definitely. I've been asking myself this same question. It's like, how do so many people have
never heard of it before, right? Where did all this cash come from?
Yeah. Yeah.
But when you're out there and you can sell $1 million house and make $500,000, and you can come here and buy a $500,000 house that's probably a lot better than the one you had there in cash, and that's like what's happening.
Yeah.
Yeah.
So as far as lending standards go, what are some things that you've seen, like when you started and got in the business, started doing loans, and I guess you were a lender through the bubble of 08 and 09 and all that.
Right.
How did it kind of tighten up as far as lending standards as to who qualifies and like DTI and all that?
Sure. Like, so, I mean, when I started, it was all, full documentation in like the early 2000s. Fannie Mae and Freddie Mac did have a conventional loan that they called fast and easy. So you could state your income, but you had to be self-employed. You had to be putting 20% down. You had to have really good credit. Like, not everyone could get it. And it was there for people that were strong, but just couldn't prove on paper, right? Because lots of times self-employed people have, a hard time getting qualified, and what they really prove on their tax returns isn't what they really bring home, right?
Right.
So that was the only real product out there. But then that product just kept getting easier and easier and easier, right? The credit, the appetite for more risky credit from banks out there just kept growing and growing, and you could just see it, right?
Greed.
Then you didn't have to be self-employed. Then you didn't have to have a 680. Then you didn't have to put hardly anything down, and you could just, and you're like, man, you could do stated income, stated asset, and get 100% financing on an investment property. That's how crazy it was, right?
Oh God.
I mean, looking back, I was like, at that age, I was like, man, I should have brought like 10 of them, right? I didn't need any money out of pocket, and they were just going to basically give me a house. All I had to pay was the closing costs, and I could have even got the seller to pay closing costs.
Yeah.
So I could have bought 10 rent houses for nothing out of pocket. Like, why didn't I do it? It's even like 08, 09, when the crash happened, even if values went down, people had to rent, right? Mm-hmm. So you still had your money coming in for them. Looking back, always hindsight's 20/20.
It always is.
So that credit scale, you could just see it getting easier, and you're just like, man, these are crazy. And then all of a sudden, one day, the money just dried up, right? The bottom fell out. I had people at the closing table and like close their loan, and then all of a sudden there was like no money to send. Like, it just dried up, right? Whoa. And so kind of what happened in 2020 with the pandemic is kind of what happened then, especially like what the Fed did, right? And their tactics. So because the money dried up, like no one wanted to buy. So how loans work, right? No matter what bank you go to, your loan's going to get sold in the secondary market, right? An easy way to look at it is like, if you do a conventional loan, your loan's getting sold to Fannie Mae and Freddie Mac. They're going to pool your loan together with millions of dollars of other, like a big pool of loans. They take that pool, slice it into bonds, and they sell that bond in the open market, right? So one bank is not holding your paper, right? Thousands of people or investors are buying into your loan, right? That's what allows you to get a low interest rate for that amount of time. a bank can't hold a 30-year note at a low interest rate. They would lose and own that paper. They would lose their tail.
Inflation alone would just kill them.
Right. You can't have inflation at 8 and you're lending at 3. You're losing 5%. The bank will go belly up, right?
Yep.
And that's how it was until they figured out how Fannie came along, was created, and somebody figured out how to take a mortgage and securitize it into a bond, right? Because in the 70s and 80s, you know, or I would say it's happened like in the early 80s, but like in the 70s, you'd go to your local bank and be like, okay, you get a loan, but till Johnny down the street pays his off, we don't have money to lend. Like the bank only can lend on what they take in deposits, right? So when they figured out how to securitize it, then they could spread that out and that money out to lots of people. And then that opened up the liquidity, right? Which means there was more money to lend to everybody. So that's how the market really works. And that's what moves interest rates. So when Fannie Mae's bond gets bought or sold, that's what moves the interest rates up or down. A bond works inversely. So when everyone buys an asset or buys that bond, it pushes the price of the bond higher, which means rates go down. And then the opposite happens when everyone sells their bond and the price of the bond goes down, then rates go up. And that's what's happening right now. Like nobody wants a bond at 3% or 4% when inflation's 8%, right? Because you're losing money. So everyone's selling off their bonds, and that's pushing rates higher, and it's pushing it up quickly. So that movement is really what creates the interest rates. But what happened in like 08 and 09 is, and like kind of what happened in 2020 as well with the pandemic, is the Fed stepped in when no one wanted to buy that mortgage-backed security from Fannie. There was no money, no liquidity. I mean, Fannie almost crashed in 08, 09 because of it. But the Fed stepped in, and essentially Fannie Mae and Freddie Mac, they call them GSEs, right? Government-sponsored entities. Mm-hmm. So the government will never let them fail. They can't, right? The whole economy would crash if they did. So the Fed steps in and starts buying up Fannie Mae's bonds. So you essentially have the government buying the government's paper, right, artificially. So they created the liquidity to keep Fannie Mae afloat. And then once the economy got back and running and the market kind of corrected itself and we only did normal loans and investors had confidence again to buy mortgage-backed securities as they were based on solid underwriting guidelines and not stated loans anymore, then the Fed was able to sell off that paper and actually made money on it, right?
Yeah.
Paid back. But and same thing happened in 2020. So to keep rates low and to help stimulate the economy, the Fed stepped in and bought a bunch of Fannie Mae's paper to help push rates to 2.75, right, on 30 years, or 3.25. And they pumps a lot of money into the system, right? And that's what's creating the inflation now. And the opposite is happening. So the Fed's almost behind the curve. They probably held rates too low, too long.
Yeah.
And now they're behind the curve. And now when they start talking, we're going to raise rates. And now, instead of us buying these bonds, now we're going to start selling them. So you have the Fed becoming the biggest player in the market or buyer in the market to now maybe the biggest seller. Well, then that's going to push prices lower, right? And then, so what's anybody with a bond right now? I mean, you can lose money on a bond, right? You don't just make the interest. If you buy it here and sell it here, you're going to lose money, right? So eventually, or right away, when the Fed comes out and makes these statements, and that's what made rates go up so fast, right? Because how everyone knows how fast they got to tighten to try to squash the inflation. So then the investors just start selling those bonds off, right? And that's what's pushed our rates this high, this quick.
Yeah.
Yeah.
I remember, it was September of 2008. It was my first ever college class. First day of college ever.
Oh, wow.
And I walked into Jeffrey Jackson's accounting class at San Jack. I walked in, I sat down, and he walks in the room with like this solemn look on his face. And he just goes, y'all better be glad you're starting college right now and not finishing.
Right.
Trying to like graduate and get a job.
Right.
And I was 18. I was like, why? I didn't know.
Right.
And I think in Houston, we didn't quite feel it as bad as maybe some other parts of the country.
For sure. I mean, oil and gas, everyone always needs oil and gas, right? And the healthcare. So that helped our economy. We didn't have near the huge run up that we did in prices like they did in the South Floridas and the, Californias. So I think we like you said, we didn't have it near as bad, but that's why people want to come here, because we do have such a solid foundation and good home prices and, good tax. We don't have, the taxes are cheap here. It's, cost of living is so much less, right? You always hear about
no state income tax.
Yeah. No state income tax. But you hear about, professional sports guys like, having to make this much in New York, but like, it's not more money than if you lived here. Right.
Yeah.
It's the same.
Yeah, you know those guys have to pay state income. Like, so say if you're on the Rockets and you go play the Knicks in New York, you have to pay income tax in New York.
Because you get a game check, right?
Could you imagine being those dudes' accountant trying to? Oh my gosh!
How much they got to pay a CPA to keep up with that? Which state you're in?
Yeah, exactly.
That's crazy.
But so with rates, you know, I think the best question to ask is how is this going to affect the consumer when, you know, I think my mortgage was like right at 3 flat, like 2.8, I think, or 3, I can't remember.
Yeah.
But when they jump to 6, I mean, and I kind of always tell people one of the biggest swings in your payment is going to be that interest rate.
Right.
That's going to swing your payment more than anything. Yeah. So how high do you think they could go, and how much will that affect everybody's buying power?
Yeah. I mean, I think, I'm thinking, I'm hoping. I mean, obviously, if I knew where rates were going, I wouldn't be sitting here, right?
Yeah.
I'd have my own island, is what I always say. So, you know, it's always a prediction. I think that, and what I read most and, you know, following the market and other economists out there, that hopefully this 2022, we're going to stay in this 5 to, you know, maybe 6% range, hopefully stay in the 5s. So I think this jump that we've made is, you know, everything's about expectations, right? So I think everything that's happened to rates and happened so quickly is all about what everyone expecting the Fed to do. So all that's really built in and how much they're going to tighten. So as long as they kind of stick with what they're telling investors they're going to do, I think a lot of what they're going to do in the next year is already built into the price, right? So hopefully I think we stay about where we're at. I can tell you, like, you know, if you do a $400,000 house, you put 20% down, that's like a $330 loan amount. Then or 320 loan amount, then, you know, if you're at, you know, 3.5% versus say 5.5%, your monthly difference in payments about $325.
Yeah.
So I mean, it's substantial, but I mean, if you're buying a $400,000 house, $325 a month, I mean, it's still definitely doable, right? I feel like. So I think that they're still affordable. The affordability is still there. It's nothing crazy. And I think a little bit of the sticker shock is like where people like have the problem that it's so fast, that it came up so fast.
Right.
But I mean, again, we talked about in the very beginning, historically, right? I was refinancing people at 6 and they were thrilled. So my first house was at 6.25. I didn't think anything about it. Right. And you know, people were at 8 and 9 in the 90s. So again, historically speaking, we're still in definitely the low end of the range. And really, the anomaly in the rate is not where it's at now. It's the anomaly was the 2.75 and the 3.25. Right?
I said that the other day to someone.
Right. So that was just the blip in the radar. This is where it really needs to be and is what's normal if we don't want 8.5% inflation.
Right.
Right. So, I mean, so in that buying power, then, you know, I think it could hurt some people. I think it hurts more people on the lower end of the scale. You know, the higher discretionary income you have, the more, right? So if you're at 50% debt ratio if you make $5,000 a month, that only leaves you $2,500, right? And left over. Where if you're at 50% debt ratio with $10,000 a month, then you got $5,000 in the discretionary or extra. So that 325 shouldn't keep you from buying, right?
Yeah.
And it's all cyclical, right? I mean, you got buy now, people stay in their house average 5 to 7 years, and we'll have another chance for a refi boom.
Yeah, exactly. You can always refi later when it goes lower,
right? And I even got some people looking at ARMs now, because you can do a lower interest rate with the ARM, and you get it for 5 or 7 years, and then in that amount of time, either you're going to move or you'll have a chance to refi out of it and get the lower rate and go to the fixed option.
Right.
So it can become a viable option for some people.
Yeah. The unique thing about the situation we're in right now is the inventory shortage. So part of me is like, man, no matter how high rates get, if there's nothing for sale, like if there's it's like you were saying, it's simple supply and demand.
Yeah. I mean, and there's so lack of supply, any slowdown in the demand won't kill the prices. If anything, level off. I mean, I got somebody just bid $55,000 over on the house and still not get it. Mm-hmm. It's crazy.
Yeah. A couple weeks ago, I wrote offers on 2 boat. One of them was $25,000 over, partially waived appraisal, and then for they lost that one, and then the next one we did $25,000 over and fully waived the appraisal and lost that one.
Still didn't get it.
Yeah. I mean, it was on the golf course, so probably some old dudes wanting to live on the golf course that
willing to
been
pay.
Saving their pennies forever.
Yeah.
So, Yeah. Okay, so one final question. I've been seeing, I'm a big YouTube guy. I go down these rabbit holes on YouTube about a lot of things,
Yeah.
but real estate being one of them. And there's this channel, this guy, I mean, everything is fire sale, wave of foreclosures coming, the Fed's crashing the housing market on purpose.
Yeah.
And it's very clickbaity to me.
Right.
But the dude will put up graphs and like show statistics and stuff. That's it makes sense.
Right.
So he was saying that, like, I know that the quality of loans that like you write, for example, are much, much better than they were during the bubble.
Sure.
I mean, yeah. It's like not even close.
Right.
But he was basically saying that people can't afford these high interest rates and payments and that bad loans are being written. And I don't buy all that. But he was saying how the average home price is as high as it's ever been. And then we've never had these high of rates with this high of home prices. So he was saying that that's going to cause a massive wave of foreclosure.
Yeah. I mean, there's definitely probably an affordability like correlation, you know, that you're going to see a pullback or a slowdown in the market for sure. I mean, again, it's just the appetite for the consumer to do it. But I mean, it all just still comes down to the economy too, right? I mean, if the economy's still rolling and people have a job and they have the same money we qualified them with, then there should be no issue, right? And then what else did he say as far as like, was he just doing like historically? Because yeah, I mean, we are probably at the highest peak we've been in prices, and definitely in our area, right? And then as far as the other areas like in California and those places, it's where it was at in like 08, 09. But again, it's the supply and demand, and what pushes the supply and demand, right? Before it was the demand that pushed the prices where they're at, and it was artificial demand basically. Now it's not, and it's the supply. So even if you lose a lot of buyers, then you know you have a slowdown there. Then and just because the market slows down doesn't mean people are going to go into foreclosure. I mean, people went into foreclosure last time because they had a house they couldn't afford and they didn't prove they could afford it. Now we did, or we have.
Yeah, they're a lot better pre-qualified now for the loan.
Yeah, exactly. I got a lot more people putting more money down. You know, people had good equity in their current house to put over into the next house. So when someone gets 100% financing and gets the seller to pay closing costs and they have no skin in the game, then it's easy for them to walk away.
Right.
And that's not the case now, right? People got lots of people put money down and had a house to sell and, you know, have skin in the game. And
you got $100,000 in equity in your house, you're going to do everything you can not to foreclose.
Right. So before, I mean, you got to have something in it, and there was no equity there, even if it goes down some, but I just don't see the way prices could drop like they did before without a huge increase in the supply. And with the supply chain issues and builders, I mean, they can't keep up.
Yeah.
They can't build enough houses, right? I mean, that's what it takes. There's just not enough homes. And I mean, there's not even enough places to rent either, you know?
Yeah. Multifamily is actually outpacing single family right now.
And increase in rent prices.
Yes.
Yeah. I mean, it's costing, right.
Because so many people are just like, screw this. We're not buying a house. We're going to rent. So what does that make? More renters.
The same thing.
Then the developers say, hey.
Right. Let me jack up the rent.
Yeah.
Supply. It's just a simple supply and demand, right? Like we said multiple times.
Yeah.
So, and it's hard to say those, like you said, the clickbait YouTube guys can get down that rabbit hole and get a little crazy. But I mean, historically speaking, if you look at the trends, I mean, you're going to have some pullbacks, but it's all cyclical. You know, it's gonna come, it's gonna go, right? And if it does happen, there's foreclosures. I'm like, that's when like hopefully you got some money and you can go buy some up, right?
Yeah,
because it's going to come back.
Yeah,
you know,
that's kind of my thought right now.
Right. So I mean, you know. When you see Warren Buffett buying up the stock market when it goes down, you should do the same.
Yeah.
He knows what he's doing, right? Like when 2020, when it dropped, you know, that little blip in the radar when the market fell out and what the Dow was almost to 30 and it dropped to 18. Mm-hmm. I know dudes have made so much money buying in at 18, you know, because where'd we go back to 35 now, 33? Yeah. So
I started investing in stocks about 3 years too late. I mean, dude, I could have killed it. And I was just scared to let that money go, you know, to just send that wire to some guy far away that you've only talked to on the phone. It's nerve wracking.
No, for sure. For sure. You know, when you build wealth, I mean, you got to make money with your money, right? If you got it sitting in the bank right now, your $100 only buys you, you know, $92 worth of something right now, right?
It's getting slaughtered if it's sitting in the bank right now.
So you got to be making money and figure out ways to make money with your money. And obviously you got to keep some liquidity, right? You got to have a safe and a nest egg that's, maybe, losing some of that money, but hey, we're 100% commission. And when the downturn happens, I need some cash, right?
Yep.
So it's going to come, it's going to all rotate through, but, and that cycle is going to turn. Like I said, historically speaking, it's like every 7 years there's a recession, right? And a recession literally means 2 quarters in a row of declining GDP growth, right?
Kind of a loaded word. Yeah.
Right. So everyone hears recession and freaks out, right? But we've all lived through one already, right? In 08, 09, and that was the worst one in history, and you probably turned out okay, right? So if you can invest for the long haul is what it's about, right?
Yeah.
If you can make just 7% on your money, then your money's going to double in the market every 11 years, right? So if you can do that for 30 or 40 years, you're going to be good.
Yeah.
Some of the best guys I see are the guys that go get a trade, don't go to college, just go get a trade, go work at the plants, max out their 401k, and then when they retire, they got a couple $1,000,000 in the bank, And they always had a 700 score because they never went to college and messed it up.
Yeah.
It's where I see the market kind of trending, right? Some of the worst things I see is the high student loan debt and with a sociology degree, right? I'm like, what are you going to do with that? It's not going to make you any money and you're $100,000 in debt.
And you can't foreclose on it,
right?
Or declare or file for bankruptcy or whatever.
Yeah.
Default on it.
So, I think everyone's like, it's trending away that, if you don't have a 4-year degree, you're a loser, right? That's what kind of way it was. Like, if you're not going to college, I'm like, just go get a trade and you can make just as much or more money. You know what I mean? Than going to college.
Yeah.
So, and then be better off in the end, because the earlier you do it, the more you start saving, the earlier you do it, you'll have exponentially more.
Yeah.
Yeah.
Crazy. Well, cool, man. Anything else you want to add?
No, man, like I said, we've kind of repeated that, you got to have a house, you got to have a place to live. We're still in a really good time. The economy's well. Don't let the news scare you.
Yeah.
You got to have a place to live. You need that forced savings. And historically speaking, we're still on the low end of where rates could be. And really, this is a normal market where they should be. They shouldn't have been as low as they were as long, and that's what's creating this inflation. But to put a stop to it, the Fed's got to tighten, and this is what it does. So
yeah,
hopefully we've hit the max on this inflation, and we'll start to see some recovery in the supply chain through this next year, and then I think rates are going to hold about where they're at, maybe get up to the high 5s is what I'm thinking. Mm-hmm. But still again, stay historically affordable.
Yeah. So. Cool. Well, that's great information, man.
Man, I appreciate you having me on.
Yeah, this was fun.
Yeah.
So I guess we'll go grab some lunch now.
Sounds good.
All right. Later, y'all.